Hello, and welcome to the module on electronic banking. As your reading stated, banks have been in the forefront of using computers and technology, and really, electronic banking, you could say, started in the 1950s when they started using computers for calculations. And it has just continued to progress from there, with documents being filled out electronically and math being done electronically. I mean, there was a time when banks had to keep, handwritten records, and that is no more the case. But what we're really focusing on now is the fact that the customer experience is electronic. So while banks have been using electronics for their backroom processing for a long time, and they continue to do that, and that's a significant issue with the regulators and with security. What has really changed is that the customer interacts with the bank electronically. And in 2000, according to the FDIC, only 37% of banks had an electronic process or way for customers to access their accounts. And many of those were still even only view their accounts, not actually do any transactions. And of course, needless to say, now 100% of banks offer some kind of electronic access. There were some early internet banks. The idea was that they could be more efficient if they didn't have to have a brick and mortar location, they didn't have to have employees. Unfortunately, those all failed. But that is not the case today. There are all online banks, and it really shows you how you really have to get customer buy-in for things to be successful. So it has been possible for quite a while to do banking all electronically, but the law, of course, hasn't always caught up, and then just the simple customer acceptance. So there are other pieces of electronic banking, things like smart cards, even ATMs, and the whole ACH, being able to use your bank account online, not having to have a paper check. Those are all part of this huge technological change. And one of the things that has held true is that, although electronic banking may seem that it would be a cost saver, it's also very expensive because the technology is changing and there's constant new security risks. And so for many banks, the move to electronic banking has maybe not been the financial reward they thought it would be, because there are just as many sort of compliance issues that are new, that have arisen, that have, as they have maybe taken down the number of employees and the number of offices. So I don't know that it's a net gain, but it's certainly the way of the future. So from a compliance standpoint, we're really always concerned about risk, and there are a lot of risk in electronic banking. And part of it is, how do we take these disclosures and these disclosure laws that were all written in a paper mindset and provide them on a website, or even now on a mobile phone? Are they accurate? Do they comply with the law? How do you get people to contract and agree to them? And, the space on your phone is so incredibly small. So it's a whole new mindset, just giving the information and making sure that customers are getting it, seeing it, agreeing to it. Of course, there's all the security. As we know, we hear about a security breach every day. What can you do to prevent that? But there's always this balancing with not making it so difficult for the customer that they become frustrated. And then when there are problems, where do the liabilities lie? And, who's at fault? Who has the obligations? And when there's fraud, and this comes up more often than you'd like, is it the bank's fault? Is it the customer's fault? When these fraudulent transactions come out, there's a lot about that with Venmo and some of these transactions where people pay the wrong party, and are you just out? And there's also a concern, and this was sort of part of the, Signature Bank failure, the liquidity. That when people had to go to the bank to take out their money, that slows them down. First of all, in the old days, they had to hear about it. And second of all, they had to physically get there, and they could only go there when the bank was opened. But now you can hear about it or see it on your phone, and you can pop right over to your account and try to take it out right away. I know my son-in-law has a business. They banked at a bank that it was widely reported was going to fail. And he tried to move it right away on his phone, but there were delays. And so things can be fast and slow when you're doing things online. And of course, our big issue is the legal and compliance list. What laws apply and how do they apply if they weren't written for the environment in which we currently are operating? What if they are really written? We'll study some laws that are really location-based. How do you deal with that? They're paper-based. How do you comply? Or they're just not dealt with at all. The product is completely new, or it appears to be completely new. How do you stick it into one regulatory scheme? And if you get it wrong, then there's a real reputation risk because it's the name of the bank that'll be all over the news. So I did ask you to look at this FFIEC guidance, and that is guidance that's written for all different types of banks, regardless of their regulator. And it talks about some of the security issues. It's really focusing on, what needs to be thought about. And one of the things that you'll note and that they state in that guidance is that they cannot endorse a single technology or a single way of doing things because technology is always changing and just as quickly the scammers are coming up with new ways to get around it. But there are general principles and there are certain things like we see here, encryption. I mean, that's essential, obviously, secure transmission, multi-factor authentication. But it does talk about, the server side, where you hold the information. How do you have firewalls to protect others from getting in, to protect the documents? How do you authenticate those entering and how do you limit access to that information? Then, of course, there's the transmission, the security of the emails and the encryption, which is, as I mentioned, now become the standard. At one time, it was very difficult and expensive. Now it's just what you must do. But even more so, if you're on the customer, looking at the customer side, people want it to be easy. They want to use their home computers and their mobile phones, and they may not be very secure. And that is where a lot of problems can arise. That customers, do the wrong thing or have devices that allow access to sensitive information. So, some of the goals that have to be in any security program is, of course, to protect the customer information. I mean, that's the bottom line, not to get it out there in the public, but not to get it in the wrong hands. And part of that is the goal and the requirement to think about potential threats and hazards. Who is going to want to get this? Where is it coming from? Because if you don't think where it's going to come from and what are the risks, you can't protect against them. And you also have to think about, where's the greatest harm? For example, someone having money taken out of their deposit account is going to have a greater harm than someone having fraudulent charges. So if you have a fraudulent charge, you can dispute it and have it taken off. But if you have your money gone, you can't make your payroll or pay your mortgage. And one of the things that has gotten more attention, but originally wasn't quite as well thought through, is what do you do with the information when you're done with it? You can't just, throw it away because you never know who may try to look at it. You must destroy it in a way that it is no longer accessible. And so as a compliance professional, it's very important that you have ongoing risk assessments, not just, once, but sort of on a regular basis, thinking about where are the risks coming from. And this is the kind of thing you may get through attending meetings and hearing what other people are experiencing. And fraud detection, always being on the lookout for suspicious activities. Do you see certain patterns before you have a breach or before you have an unauthorized transaction? And also looking at the layered security. One of the things they talk about is, not just a password and a security question, which was kind of what they did for a while with consumer accounts, because those are two things that which means they can be guessed and they can be hacked. So you need sort of to have something and something you have. It's something else. Maybe you're, doing matching with the computers and the location, but what if you're on vacation? every time you come up with something, you have to think about the consequences and how it can inconvenience the customer. And of course, business transactions and high dollar transactions are far riskier. For large business transactions, you may require, some kind of a telephone call or some kind of a confirmation from another source. But all of this is a very important part of the risk management. What are your risks and how do you minimize them? How do you make sure that they're not going to, end up in something that is splashed really like all over the headlines? And so obviously, as a compliance professional, you're going to really need to understand what is going on in the industry and really, where folks are seeing problems so that you can design your systems. And this really kind of ties into our next module, which is the fintechs, because as banks get more and more into technology, they really are required to rely on third parties who have that technology insight, because it may not be, enough to use only in-house people. We're seeing more and more sort of reliance on those who are outside the bank and can bring some of these more sophisticated programs and more sophisticated risk controls to the bank. One of the things that has really moved the banks toward electronic banking was this Federal eSign Act, and it was enacted in 2001, which may give you a bit of a sense of why things have progressed so well. And so this was a federal law that basically said a signature, contract, or other record relating to a transaction cannot be denied legal effect, validity, or enforceability solely because it's an electronic form. And it also said that a contract relating to such transactions cannot be denied legal effect, validity, or enforceability because it's an electronic signature or electronic record was used in its formation. So this was the first federal law that paved the way to be able to rely legally on electronic documents and electronic signatures. Prior to this day, it was very ambiguous. And people were still requiring, wet signatures on pieces of paper. So the definition in the Act of an electronic signature is any sound, symbol, or process attached to or logically associated with a contract or other record and executed or adopted by the person with the intent to sign the record. So this is, over 20 years old, but it still works because it's very broad. And the real key is that the person does what they do with the intent to sign. So it can be clicking a box, it can be putting in your initials, it can be using DocuSign, which generates a signature. But what is key is that there was the intent to sign. And of course, it has to be presented to the person in such a way that the person understands that this action is a signature. It's worth noting that it also talks about an electronic sound. And so it can also be on a telephone, stating, I agree. The key is for any of these electronic processes is that there must be a record maintained so that the bank can prove there was an electronic record. So in the past, you had a piece of paper that the person signed. Now you may have a recording or you may have a computer record of what the person signed. So that is the key. Then with the contracting, the real key is, how do you get people, particularly consumers on mobile devices, how do you get them to agree? And this is a real challenge. So there is the click wrap, known as the click and accept. Do you just give them a link and say, click and I agree, and they may never open it, and you can tell they never opened it because you have that kind of a record? Do you require them to open it before they click I agree? Or do you require them to open it and scroll to the bottom to click I agree? Those are all different ways of getting a signature and an agreement. But how much does the bank want to make the person go through? And how will that impact its enforceability? One of the things that we have seen is that the courts are pretty open to depending on how important the document is, they're pretty open to telling the customer, you need to open this and you need to read it, and then you need to sign it. And if the customer doesn't do those things, but still signs it, the customer is typically held to it. Now, if it's something more unexpected or more unusual, it becomes more important that you require the customer to open it or that you point out any unexpected provisions. And so, there are, we go through this a lot with our clients. They always want everything to be fast and frictionless, and that's great. But you also want to be able to prove the person agreed. Now, there is this concept of a browse wrap, which basically means a customer goes on the internet or goes on something on their phone, and because there's a link somewhere at the bottom in terms that they've agreed to that. That's probably okay for something that's more like a notice, a privacy policy that your person doesn't have to sign for, but it's not very binding for anything that is kind of specific and detailed or anything the person probably doesn't want to do, like paying back a loan. But even with the click wrap, I see all different degrees of difficulty. And so that's really something that compliance people and the business people and the lawyers have to get together and really agree on, what they're comfortable with, and really, what is the bank's level of comfort and how much friction are they willing to put up with versus really wanting people to know. One of the things that is interesting under e-sign, which was enacted again, as I said, in 2001, is that we're required disclosures and notices in consumer transactions. The consumer must consent. And so I always like to ask if anyone who transacts anything online, like paying your credit card bill or accessing your deposit account, do people recall consenting to electronic records? Because it is required that a notice be given which lays out certain items, which include the hardware and the software and how to withdraw your consent, and that the person agrees to it and is then given a copy. And so there is this additional step, and we do occasionally see banks who have somehow forgotten this in the consumer context. So it's very important anytime there's an initiation of a consumer transaction that's going to occur electronically, that this e-sign consent be obtained. And it should be drafted as broadly as possible. So there are quite a lot of different legal issues, and they're constantly changing. But what is really not changing is the importance of electronic security programs. And this really, if you think about it, kind of dovetails with the Patriot Act and the anti-money laundering, because breaching the systems, it's bad for the customer, but it's potentially also bad for allowing kind of illegal activity to occur. So these are all very, very important compliance areas in any kind of banking and financial institution. So if you have any questions about this, please feel free to reach out to me. And in the next module, we'll talk a little bit more about this, but specifically in the context of fintechs. Thank you.